October 19th, 1987. It started like any other Monday, but it would end as a day burned into the memory of every trader, every investor, and anyone with a stake in the American economy. A day that proved technology could not only build fortunes but vaporize them at the speed of light. This was Black Monday, and what happened would change Wall Street forever. Imagine this. You wake up, grab your coffee, maybe glance at the morning paper. The market's a bit jittery, but nothing too alarming. You head to work, thinking it's just another day in the bustling world of finance. But by the time the closing bell rang, the world had shifted on its axis. The Dow Jones Industrial Average had plunged an unbelievable 22.6% in a single day. Let's put that number into context, because it's so staggering it almost loses meaning. We all know about the legendary crash of 1929, the one that kicked off the Great Depression. On its worst day, October 29th, the market fell 12.8%. That event plunged the world into a decade of economic despair. Black Monday in 1987 was nearly twice as bad. In 8 hours, the market lost almost double what it lost on the most infamous day of the 1929 crash. It was a financial cataclysm on a scale no one had ever witnessed. The value wiped out was more than the entire gross national product of France at the time. Fortunes built over lifetimes disappeared in the time it takes to watch a movie. The floor of the New York Stock Exchange wasn't just chaotic. It was a scene of pure, unadulterated panic. Seasoned traders, men who had seen it all, were described as looking shell-shocked, their faces pale with disbelief. So, what caused this financial earthquake? It wasn't a war, a natural disaster, or a political assassination. The culprit was something new, something seductive, something that promised to remove risk from the market entirely. It was a new piece of financial technology called portfolio insurance. The idea behind it was brilliant, at least on paper. It was an automated computer-driven strategy. The programs were designed to protect large institutional investors, like pension funds and mutual funds, from market downturns. The logic was simple. If the market started to fall, the computers would automatically sell stock index futures to hedge the portfolio. This would limit the losses. If the market went up, the computers would buy, allowing the portfolio to participate in the gains. It was marketed as a way to have your cake and eat it all, the upside of the stock market with none of the downside risk. It was the holy grail of investing. And by 1987, an estimated $60 to $90 billion worth of assets were managed using this strategy. But on Black Monday, this elegant solution revealed its fatal flaw. The system worked perfectly, too perfectly. As the market began to dip on that fateful Monday morning, the portfolio insurance programs kicked in. Just as they were designed to do, they started selling. But here's the problem. Everyone was using the same strategy. All these different computer systems, all programmed with the same logic, began to sell at the same time. This created a vicious, self-reinforcing feedback loop. The initial selling pushed prices down. This drop in prices triggered the next level of programmed selling from other computers. This new wave of selling pushed prices down even further, which in turn triggered even more automated selling. It was a digital avalanche. The very tool designed to protect investors from a crash was now creating one. The machines were selling to other machines in a terrifying, closed loop of logic, with no human intervention to hit the brakes. The sellers were not selling because they believed companies were suddenly worthless. They were selling because a line of code told them to. The market safety net had become a trapdoor. Human traders on the floor were completely overwhelmed. The ticker tapes were running so far behind they were useless. No one knew the real price of anything. Imagine trying to make a rational decision when the information you have is an hour old and the market is in freefall. Panic set in. Human investors, seeing the tidal wave of selling from the computers, joined the frenzy, desperate to get out at any price. It was a stampede for the exits, but the exits were getting smaller and smaller. The market wasn't just falling, it was evaporating. There were no buyers left. The system had broken down. And this wasn't just an American story. In the 1980s, financial markets were becoming globally interconnected for the first time. Money could flow across borders with the click of a button. So when New York sneezed, the rest of the world didn't just catch a cold. It got pneumonia. The crash ricocheted around the globe with terrifying speed. When markets opened in Asia and Europe, they followed Wall Street straight down. Hong Kong's market was hit so hard they had to shut it down for 4 days. When it finally reopened, it cratered, losing 45.8% of its value. Australia fell 41.8%. The UK, France, Germany, every major market was a sea of red. It was the first truly global financial crisis of the computer age, a terrifying demonstration of how interconnected and fragile the new global system was. The world held its breath. In the aftermath of Black Monday, the headlines were apocalyptic. Pundits and economists predicted the end of prosperity as we knew it. Many were certain that a new Great Depression was not just possible, but inevitable. The psychological shock was immense. The belief in an ever-rising market, a hallmark of the Reagan-era bull run, was shattered. People who had piled their life savings into the market, confident in their 401 kiloseconds and retirement plans, saw decades of hard work and careful planning vanish in a matter of hours. The American dream felt like it was turning into a nightmare. But then, something remarkable happened. The Great Depression 2.0 never arrived. The economic catastrophe everyone feared never materialized. Why? What was different this time? The answer lies in the response of the Federal Reserve, led by its newly appointed chairman, Alan Greenspan. He had been in the job for only 2 months. What a welcome that was. Unlike in 1929 when the Fed tightened the money supply and made things catastrophically worse, Greenspan and the Fed of 1987 did the exact opposite. On the morning of Tuesday, October 20th, the day after the crash, the Fed issued a short, simple, but incredibly powerful statement. It said, and I'm paraphrasing here, that it was ready to serve as a source of liquidity to support the economic and financial system. In plain English, the Fed announced to the world, we will print whatever money is necessary to stop this panic. They opened the floodgates of cash, slashing interest rates and encouraging banks to continue lending. They were basically telling the market, don't worry about the plumbing. The money will be there. This decisive action broke the back of the panic. It reassured investors that the financial system itself would not collapse. It gave banks the confidence to lend to brokers who were on the verge of bankruptcy. It restored a sense of order to the chaos, and it worked. The market found a bottom. It began a slow, grinding recovery. But the most incredible part is how quickly it bounced back. While the 1929 crash took 25 years to recover from, the Dow Jones returned to its pre-Black Monday highs in just under 2 years. By September of 1989, it was as if the crash had never happened, at least on the stock charts. Black Monday became a crucial lesson for central bankers around the world. It created the Greenspan Put, the playbook for how to respond to a market crisis, flood the system with liquidity, cut interest rates, and do whatever it takes to restore confidence. This playbook has been used time and time again. In the 1998 long-term capital management crisis, after the 9/11 attacks, during the 2008 financial crisis, and again during the 2020 pandemic crash. So Black Monday stands as a fascinating and terrifying moment in financial history. It was a story of technological hubris, a cautionary tale about the dangers of automated systems and the illusion of risk-free investing. But it was also a story of a crisis averted, of a new model for crisis management that would shape our economic world for decades to come. It taught us that markets can break, and that technology can accelerate that failure to terrifying speeds. But it also taught us that with swift, decisive action, a full-blown catastrophe can be avoided. It was a dress rehearsal for the financial crises of the 21st century. But 19th, 1987, it was a day of pure, unadulterated panic. The Dow Jones Industrial Average plummeted an astonishing 22.6%, the largest single-day percentage drop in its history. Fortunes were wiped out in hours. The air on Wall Street was thick with fear, and the world held its breath, bracing for what seemed like the inevitable start of another Great Depression. But then, something incredible happened. The collapse stopped. The market didn't just stabilize. It began a historic recovery. What caused this impossible turnaround? The answer lies in what one man and one institution did in the critical hours that followed. The morning after the crash, on Tuesday, October 20th, the future of the global economy hung by a thread. The system was frozen. Banks were terrified to lend, even to each other. Brokerage houses were on the verge of collapse, unable to meet their margin calls. It was a classic liquidity crisis, the financial equivalent of a heart attack. Everyone needed cash, and no one was willing to provide it. The panic from the stock market was about to cascade into the banking system, which would have been catastrophic. At this pivotal moment, all eyes turned to one place, the U.S. Federal Reserve, and its newly appointed chairman, a man named Alan Greenspan. He had only been in the job for 2 months. Now, he was facing his first, and perhaps greatest, test. At 7 a.m. that morning, before the stock market even opened, Greenspan and the Fed made their move. They didn't call a press conference or release a complex policy paper. Instead, they issued a single, masterfully crafted sentence, just 13 words that would echo through the halls of finance for decades to come. The statement was simple, direct, and powerful. It read, "The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system." That was it, 13 words. But in that moment, they were the most important words in the world. Let's break down why this short statement was so brilliant. Greenspan didn't promise specific actions. He didn't say how much money he would print or which banks he would save. Instead, he delivered a powerful psychological message. He signaled that the full unlimited power of the United States Federal Reserve was now on the table. He was essentially telling the market, don't worry about cash, we have an infinite supply, and the tap is open. This wasn't just a promise. It was a projection of overwhelming force. It was a direct challenge to the panic itself. Greenspan understood that a liquidity crisis is fundamentally a crisis of confidence, and the only way to fight a crisis of confidence is with an even greater display of confidence. And the Fed backed up its words with immediate, massive action. This wasn't just talk. On that same day, October 20th, the Fed launched what can only be described as a monetary shock and awe campaign. They pumped an unprecedented $17 billion into the financial system through what are called open market operations. To give you some perspective on that number, $17 billion in 1987 represented 25% of the total reserves held by all banks in the entire United States. Think about that. In a single day, they increased the core foundation of the banking system by a quarter. It was the equivalent of unleashing 7% of the nation's entire monetary base in a matter of hours. The message to Wall Street was loud and clear. Liquidity would not be a problem. The Fed also took other decisive steps. They publicly encouraged commercial banks to continue lending to brokers and dealers on normal terms, effectively giving them the central bank's blessing to take on risk. They started their daily market operations an hour earlier than usual, a visible and symbolic signal of urgency that every single trader on Wall Street would have noticed. They also cut the federal funds rate, the key interest rate they control, by 0.5 percentage point. Each action was designed to reinforce the central message. The Fed was in control, and it would do whatever it took to keep the system from seizing up. The panic began to subside. The promise of liquidity was enough to restore just enough confidence for the system to start functioning again. Now it's crucial to understand the context of the time. The economic environment of 1987 was perfectly suited for this kind of aggressive monetary intervention. This is a key point. Greenspan's strategy worked so well because the underlying fundamentals of the US economy were actually quite strong. First, let's talk about national debt. In 1987, the US national debt was around $2.4 trillion. While that sounds like a lot, it was only about 50% of the country's gross domestic product, or GDP. That's a very manageable level. It meant the government had significant financial flexibility. It wasn't constrained by a massive debt burden, which gave the Fed's actions more credibility. Second, and perhaps even more importantly, was the inflation situation. In the late 1970s and early 1980s, the US had battled crippling inflation, but by 1987, the war had largely been won. Inflation was not only under control, it was actually falling. This gave the Fed enormous room to maneuver. They could flood the system with money without the immediate fear of igniting runaway price increases. If inflation had been high and rising, printing vast sums of money would have been like pouring gasoline on a fire. But with inflation low, the Fed had a green light. The strong economic fundamentals provided the perfect backstop for Greenspan's bold intervention. His shock and awe tactics weren't just a gamble. They were a calculated move based on the sound economic reality accessorios of the time. The result was nothing short of miraculous. The New York Stock Exchange, which had been on the brink of shutdown, remained open. Brokerage firms, which were hours from insolvency, got the loans they needed to survive. The banking system, which had been frozen in fear, began to thaw. The stock market found its footing. While it took time to recover fully, the catastrophic system-wide collapse was averted. The world didn't end. The Great Depression 2.0 never happened. And Alan Greenspan was hailed as the maestro, the man who saved the world economy with a single sentence and a flood of cash. This event, the Greenspan Put, as it came to be known, reshaped American finance. It established an implicit understanding that, in times of extreme crisis, the Federal Reserve would step in and provide a safety net. This policy had profound consequences, both good and bad, for the decades that followed, influencing everything from the dot-com bubble to the 2008 financial crisis. The response to Black Monday became the playbook for future crises, a demonstration of the immense power of a central bank to calm panicked markets. It was a lesson in the psychology of fear and the power of overwhelming force. The day the market almost died became the day the Fed learned just how powerful it truly was. Thank you so much for watching. The story of Black Monday is a fascinating chapter in financial history, filled with lessons that are still relevant today. What do you think about the Fed's actions? Have you ever heard of the most dangerous insurance policy ever created? It wasn't written by a company. It was created by the Federal Reserve, and for nearly 40 years, it has shaped the very foundation of American finance. This is the story of the Greenspan Put and why the safety net you think exists is about to vanish. It all started back in 1987. On a single day known as Black Monday, the stock market crashed by over 22%. Panic was in the air. But then, something unprecedented happened. The newly appointed Federal Reserve Chairman, Alan Greenspan, stepped in. The Fed announced it was ready to provide liquidity to support the economic and financial system. The message was clear: we won't let you fail. And it worked. The market stabilized, and a crisis was averted. But this successful rescue planted a seed, a dangerous idea that would grow into an unshakable belief for generations of investors. This was the birth of the Greenspan Put. The put in Greenspan Put is an options term. A put option gives you the right to sell an asset at a predetermined price, protecting you from a price drop. The market began to see the Fed as a giant, cosmic put option on the entire stock market. The belief became entrenched: if stocks fall too far, don't worry, the Fed will intervene. The cavalry will always ride to the rescue. For the next 4 decades, from the late 80s all the way to today, American investors learned a simple, yet incredibly toxic lesson: always buy the dip. Don't fight the Fed. Trust the system. They'll always be there to save the day. And why wouldn't they believe it? This lesson was reinforced, again and again, becoming observable reality. In 1998, the collapse of the hedge fund long-term capital management threatened to take down the global financial system. What did the Fed do? It orchestrated a bailout, injecting emergency liquidity. The market was saved. Just 2 years later, in 2000, the dot-com bubble burst. Stocks plummeted. What happened? The Fed responded with aggressive interest rate cuts, flooding the system with cheap money. The market recovered. Then came the big one, the 2008 global financial crisis. The entire system was on the brink of collapse. The Fed's response was something new and massive: quantitative easing, or QE. They began buying trillions of dollars of assets, effectively printing money to prop up the banks and the markets. And most recently, in the 2020 pandemic panic, the Fed went nuclear. They unleashed unlimited money printing, promising to do whatever it takes. Each and every one of these rescues hammered home the same belief: the Fed will not allow the markets to truly crash. This created a massive problem, something economists call moral hazard. It's the idea that if you know you're protected from the consequences of your actions, you're more likely to take bigger, wilder risks. Imagine if your car insurance covered every single dent and scratch, no matter how recklessly you drove. You'd probably start being so careful, right? That's exactly what happened on Wall Street, but on an unprecedented multi-trillion-dollar scale. Investors, hedge funds, and banks took on gargantuan risks, piling into speculative assets, leveraging up their bets, all because they had the implicit guarantee that the Fed would bail them out if things went wrong. Asset prices, from stocks to real estate, inflated far beyond any reasonable or fundamental valuation. Bubbles formed everywhere. The entire American financial system became structured around this core assumption of a guaranteed Fed rescue. But here's the terrifying irony: while the Fed was so busy rescuing the markets time and time again, they were simultaneously destroying the very tools they needed to perform future rescues. They were creating the precise conditions that would make the next bailout impossible. Today, Wall Street is still operating under the 1987 playbook. They are waiting for the next dip, the next crisis, so they can buy in, confident that the familiar rescue blueprint will be rolled out. But the ammunition that made all those past rescues possible, it's been systematically spent, used up, and exhausted. Fast forward to the near future, let's say 2026. Every single condition that allowed Alan Greenspan to act so decisively back in 1987 has been catastrophically reversed. The safety net has been shredded, and almost nobody seems to realize it. Let's break down exactly why the next rescue isn't coming. First, the liquidity weapon is corrupted. Back in 1987, the Fed injected what was then a significant amount of money to stabilize things. That rescue, adjusted for the market size, was equivalent to about $17 billion today. That injection was absorbed safely, without causing runaway inflation, for one simple reason: the US national debt was small and manageable. In 1987, our national debt was about $2.4 trillion. Our debt-to-GDP ratio, a key measure of a country's financial health, was a healthy 50%. This meant the economy had the capacity to absorb that new money without overheating. Now, let's look at the picture in 2026. Our national debt has absolutely exploded. It's not $2.4 trillion anymore. It's projected to be over $36 trillion. Our debt-to-GDP ratio has more than doubled, soaring from that manageable 50% to a staggering 123%. So what happens if the Fed tries to pull the same move today? If they attempted an equivalent liquidity injection, that new money wouldn't be hitting a stable base. It would be hitting a debt base that is 15 times larger. The result wouldn't be a calm, orderly market recovery. It would trigger immediate, uncontrolled hyperinflationary acceleration. The value of the dollar would plummet. The cure would be infinitely worse than the disease. Furthermore, the Fed's own balance sheet, which was pristine in 1987, is now bloated to over $7 trillion from all the past QE programs. The quantitative easing ammunition is, for all practical purposes, exhausted. They can't just print trillions more without collapsing the currency. The liquidity gun is empty. Second, the interest rate firepower is depleted. This was the Fed's other primary weapon. In a crisis, they cut interest rates to make borrowing cheaper and stimulate the economy. In October 1987, the federal funds rate stood at a healthy 7.5%. This gave Greenspan and the Fed a massive runway. They had 750 basis points of room to cut rates all the way to zero if they needed to. It was a powerful tool, and they had plenty of it. Where are we today? Rates are sitting much lower, currently around 4 to 4.25%. So right off the bat, they have far less room to cut. But the problem is much, much deeper than that. The Fed cannot use even this limited ammunition aggressively. Why? Because of the one monster they unleashed with their past actions: persistent inflation. Even now, core inflation is running hot. well above the Fed's 2% target. If they start cutting rates aggressively now, inflation, which they've been fighting so hard to control, will come roaring back with a vengeance. They are trapped, and the trap gets even worse. Every rate cut now comes with a devastating price tag for the US government. Because our national debt is so immense, the interest payments on that debt are astronomical. For every 1% that the Fed cuts rates, it now costs the US Treasury approximately $360 billion in additional annual debt service payments. Let me say that again. A single 1% rate cut adds hundreds of billions to the national deficit. The Fed is caught in a doom loop of its own creation. They can't print money without causing hyperinflation. They can't cut rates without reigniting inflation and bankrupting the government. The very tools used to save the market for 40 years are now the instruments of its potential destruction. The Greenspan put is dead. The 40-year-old lesson to buy the dip is about to become the most dangerous financial advice in history. The cavalry isn't coming this time because their horses are lame and their gunpowder is wet. The market is standing on a precipice, staring into an abyss, still believing in a savior that has lost its power to save. This is the uncomfortable and dangerous reality of the financial world we now live in. The Great Reckoning, delayed for decades, may finally be upon us. Thanks so much for watching. What do you think? Is the Fed out of ammo, or will they find a new, unimaginable way to kick the can down the road? Let me know in the comments below. For decades, Wall Street has told us a comforting story. It's a story about a safety net, a guardian angel for the markets known as the Federal Reserve. The greatest trick Wall Street ever pulled was convincing everyone that the 1987 crash was the ultimate proof. No matter how bad things get, the Fed will always step in to save the day. This belief, the idea of the Fed put, became the bedrock of our financial system. It's so deeply ingrained that even questioning it seems like financial heresy. But what if the story is about to change? What if the safety net has been torn to shreds? Picture this. It's 2026. Panic is ripping through the markets. Stocks are plummeting, and investors are holding their breath, waiting for the familiar, reassuring announcement from the Fed. They expect a rescue, just like always. But this time, something is different. The announcement comes, but instead of relief, there's doubt. Why? Because the Fed's credibility is in tatters. Think back to the transitory inflation disaster of 2021 and 2022. We all heard it. Fed Chairman Jerome Powell stood at the podium, month after month, promising us that the surging prices we saw everywhere at the gas pump, at the grocery store, were just a temporary blip. He assured us it would pass quickly, but it didn't. Inflation dug its heels in, and the Fed was forced into a dramatic, painful series of interest rate hikes, playing catch-up for a problem they said wouldn't happen. That wasn't just a policy mistake, it was a catastrophic blow to the Fed's reputation. Trust, once lost, is incredibly hard to regain. So, in our 2026 scenario, when the Fed issues its emergency rescue statements, the market's reaction won't be, "Thank goodness we're saved." It will be, "Show us the money." The market will demand proof, not promises. They'll want to see the actual liquidity, the concrete actions. And that's where the real nightmare begins. There will be a delay, a crucial gap between the Fed's promise to act and their ability to deliver. In today's high-frequency, algorithm-driven markets, that delay is an eternity. Instead of calming the panic, it will pour gasoline on the fire. Fear will multiply. The sell-off will accelerate. The very tool meant to inspire confidence will instead create chaos. This crisis won't happen in a vacuum. It will erupt on a financial landscape far more treacherous than the one we had in 1987. The system is brittle, weighed down by structural weaknesses that have been building for years. Let's start with corporate debt. Companies have binged on cheap money for over a decade, pushing corporate debt levels to all-time highs. Many of these are zombie companies. Firms that don't even earn enough to cover their interest payments. They only survive because they can keep borrowing. When the credit markets freeze, they will go extinct, triggering a wave of defaults. Then there are the consumers. Your average household has been squeezed relentlessly by inflation. Savings that were built up have been depleted just to cover the rising cost of living. People are stretched thin, relying on credit cards more than ever. When a real economic downturn hits and layoffs begin, there is no cushion. Consumer spending, the engine of our economy, will grind to a halt. And we can't ignore the ticking time bombs in the banking sector. Commercial real estate is facing an existential crisis. The pandemic changed how we work, leaving office buildings half empty. These properties are now worth a fraction of what they were, but they're still on the books of banks at their old, inflated values. This is a solvency crisis waiting to happen. On top of that, our regional banks are still fragile from the mini-crisis of 2023. They are sitting on hundreds of billions of dollars in unrealized losses from bonds they bought when interest rates were low. They are one shock away from another systemic failure. All these factors, record corporate debt, depleted consumer savings, a wobbly banking system, create the perfect storm. The market is a powder keg, and the failure of the Fed's rescue will be the spark that ignites it. This leads us to the final, devastating phase of the crash, the moment of terrifying realization. Investors. from the big hedge funds down to the individual retail trader, will finally understand that the Greenspan put, the bedrock of market confidence for nearly 40 years, is dead. It's not coming back. There is no safety net. The psychological impact will be such. For the first time since 1987, asset prices will have to find their true value without the backstop of the Federal Reserve. The result, a market decline of 30, 40, even 50% is not just possible, it's probable. This won't be a quick V-shaped recovery like we saw in 2020. That was a fantasy powered by trillions in stimulus. This will be different. The recovery will be a long, arduous slog, potentially taking a decade, not 2 years. Why so long? Because the underlying problems can't be fixed with monetary policy. Printing more money won't solve the massive debt burden. It won't fix the government's fiscal crisis. And with inflation now a persistent threat, the Fed's hands are tied. They can just slash rates to zero and fire up the money printers without risking a return to runaway inflation. The ammunition they used in every previous crisis is gone. The 1987 playbook will fail because the world has fundamentally changed. As the old saying goes, the most dangerous phrase in finance is "this time is the same." Well, this time is not the same. The most tragic part of this whole impending crisis is that it's completely predictable. We can see it coming. For 40 years we've lived in a kind of financial wonderland, a world where markets couldn't truly crash because we believed the Fed wouldn't let them. That era is over. The party is ending and a painful hangover is coming. My parents always taught me a crucial lesson. The best way to control your future is to understand who is lying to you and why. The story of the all-powerful Fed has been a comforting lie for a long time, but it's a lie that is about to unravel. If you want to understand what the death of the Greenspan put truly means for your investments, for your 401k, and for your financial future, make sure you hit that like button and subscribe to the channel. We're going to navigate this together. Thanks for watching.